It's the Market Pulse podcast, where you can discover each week how to unlock the power within you to achieve success and personal growth. Here is your host, Matthew Pohl.
Welcome, Market Pulse members, to another episode of the Market Pulse podcast. I'm Matthew Pohl, your host, and I've got some incredible data and news to cover in terms of the markets. And excited to bring that to you from a uncandid, unscripted approach with really no filters and no agendas in terms of giving you the raw data around what is happening in this crazy world when it comes to the markets. And I've got some fun topics to go over. So let me just kind of scroll through what some of these topics look like to give you some insight on what to expect during this podcast. We are going to be talking about first quarter reports and the thousands of layoffs and corporate downsizing that is projected to go forward throughout the rest of 2024. And this includes jobs and also locations of different department stores and areas of regular day retail that you attend and go to that you probably have not heard on the news. We're also going to talk about the first bank closure that no one's been hearing about that happened this year, and how it's very likely that we'll see up to maybe a dozen other bank closures throughout the remainder of 2024. We're going to show a little bit about the JP Morgan Chase almost $500 million seizure from Russia, which again, another topic that no one wants to talk about. And we'll talk about why and the unpacking of why mainstream media is staying away from this topic. I had to dig really hard to get data on this, and how Russia has declared war on the US dollar, and how the US and people like you and I are just not paying attention to this, generally speaking. And it really speaks to how naive the average American is on global finance. I don't expect most people to get this information, to understand it. It's kind of fun. You see those viral videos that go on YouTube or on TikTok or any of the social platforms where individuals go out and ask people silly political questions like, how many states are there in the U.S.? And they can't even answer that question. Or they'll ask, like, what's the capital of your city? And they can't answer those questions. So, I get it. The general public is getting dumber, and I think AI is probably not helping with this. But I don't expect you guys to not understand this. And so as I unpackage this, I think it's going to make a lot of sense of what's actually going on and why the news, especially legacy news, is not reporting on this with an election year coming up. Then we're going to talk about what the nerds are up to, and we're going to talk about this new Llama 3 release, which really is shaking the AI world and is likely taking a lot of valuations to zero. So if you're someone who invested or was thinking about investing in certain AI projects, this release alone has brought certain valuations, probably billions of dollars in money invested in other companies, to nothing. And so they're going to have to start rethinking about what direction they're taking their company, which direction they're going to use or allocate these funds, or frankly close the doors and give back as much money to investors as possible. And then we're going to go into some coaching on the brain, and we'll get to that when we get to that segment. I don't want to lead in too much on that, but that's probably one of my favorite parts about this podcast. And then that should wrap things up. So how do we want to start this today?
Breaking news.
What you're about to see may disturb.
Snooze, you lose.
Well, let's start with this quarterly report that came out that is really a highlight, not all inclusive, of the many cutbacks, layoffs, and downsizing that our economy in the U.S. is facing today. And so I'm just going to list a bunch of data that I found that is showing what's happening in the economy, and you might even be seeing some of the impact of, but all together. So let me start with this. For those of you who own Apple products or Apple phones, Apple is set to cut 600 positions as of first quarter. Outback Steakhouse, you guys know the famous restaurant, is set to close 40 of its restaurants. Walmart has already closed 6 supercenters this year. eBay is cutting 1,000 jobs. Microsoft cutting 1,900 positions. Expedia cutting 1,500 positions. Walgreens closing 150 stores. Cisco cutting 4,000 positions. Foot Locker closing 400 stores by 2026. Dollar Tree closing 600 stores. And by the way, I don't know how the dollar store is even called the dollar store anymore. There's nothing in there for $1. And frankly, after inflation, $1 is going to be $10. So maybe they'll call it the $10 tree store. I don't know. Macy's is going to close 150 locations. Regal Cinemas, 429 locations closing. Kroger shutting down 413 stores. CVS cutting 12,000 jobs in 2024. Citigroup cutting 20,000 positions. So there is a lot happening, a lot of downsizing in the economy, and who's to blame? What's to blame? I think a lot of this has to do with the inflation that has been pushed into the market, and these are just the side effects that we didn't think would occur, or maybe we didn't price in would happen, and they're happening today, and this is probably the first domino that's going to kick off a series of dominoes that's going to lead to way more layoffs in companies, way more downsizing, and the numbers you don't hear about are actually the ones that aren't publicly reported, and those are small businesses where these numbers are happening and escalating at a large scale today. So while all this is happening, we're printing money, sending billions of dollars to wars that frankly we have no business being in. And while we're doing that, we have a presidential election this year, which adds lots of fuel to this fire. And the news knows that this kind of news, talking about how the economy is downsizing, how the economy isn't looking well, looks really bad on whoever the sitting president is. Now, if Trump were president right now, we would be hearing about all of this news. We would be hearing about all of the negative things happening in the economy because legacy news tends to side with the progressive either candidate for president or the standing president as it stands. And so this is why we're not hearing a lot about this, is the news wants Biden, legacy news wants Biden to be the next president. And so you're not hearing about this on any legacy stations. And the bank failures that have just happened is just contributing to this. And I had to dig. It was shocking to me how hard it was to find this news on Republic First bank seizure of $1.7 billion, by the way, guys. $1.7 billion in CRE assets. And legacy news isn't covering it. In fact, let me show you this article that it's kind of going to blow your mind at how this isn't getting reported. Look at this. This is an article by some side news market. You know, this was not CNN. This was not Fox even. This was not CNBC or CNN. This was some third-party news reporting company that, frankly, you're not going to see on legacy news. You're definitely not going to see it on TV. But it happened, and this is like hot news, guys. How many of you guys thought you should know about a bank failing? Well, it happened, and the concern, let me kind of unpackage what's going on here. First Republic failed because of their CRE loans. And what's happening and what's likely going to happen throughout the rest of the year, and maybe even in years to follow, is because interest rates have gone up, because commercial loans are typically 3, 5, 7 years max, all these commercial loans are having to get refinanced right now. And in order, say your rate was 2%, and now it's, well, let's say 4%. Let's say that your commercial rate was at 4 or 5%, and now it's almost double, 8 to 10%. Your ability to keep things running when you refinance goes way down, especially if your tenants are evacuating, especially if your occupancy rate is also diminishing. And so we are right now headed towards a commercial real estate crisis. And banks, specifically small banks, know that they are carrying most of this weight. Big banks like JP Morgan Chase are saying, we're fine, we'll be able to handle this, up to rates of 8%, which would be federal rates of 8%, which would be lending rates of about 10% on real estate, 11, 12% on commercial. And so JP Morgan is pricing and factoring all this in. They're a big bank. They have lots of experts. They're forecasting into the future quite a bit. But small banks like Republic First and many other small banks like Republic First are likely to take a hit, and their assets they'll get bought by guys like JP Morgan Chase for pennies on the dollar. And so, yeah, it's shocking to me, but also not. And for those of you who are smart, you understand this. You understand that there is a kind of a divisive political agenda to keep Biden in, even though he is the most unpopular president of all time. In fact, I want to show you an article where Biden recently became the least popular president in 70 years. And so you can see that, obviously if you are on the Biden administration and you're wanting to keep him in as president, and he is the candidate for the Democrats right now, this is not good news. We know that a poor economy for the standing president likely leads to them losing their seat. We know that if we're in a strong economy with the existing president, there's like a very high likelihood that they'll get reelected. And so all of these things are stacking against Biden. We were really hoping for rate drops. We didn't get that with inflation over the last month. We were hoping that the economy would be booming. GDP has come off significantly. We'd hope consumers and that people would be doing well. Credit card debt and defaults are an all-time record high since 2008. And now this is in Biden's poll on top of all this. And this is recent data. Like, this hasn't even set in for the average American. But Biden is the least popular president in 70 years, below Nixon and Carter. And so we have all these things stacking up against the president, and the news and his allies are doing all that they can to try to get him more positive polling and more positive outlook as a president so that he'll get reelected. 1 + 1 = 2, guys. I don't expect this to be shocking to you. This is not shocking news. However, what's going on in the market right now is a huge blow to Joe Biden. And if I were to predict what's going to happen in this election, if the market and economy doesn't somehow magically shift in a radical way, there is no standing way that President Biden will be the next president. And having said that, I want to show you this. You guys are going to love this little video. Jon Stewart from The Daily Show does this clip. And he did it on CNN, which I thought was really unique, very unique for someone on CNN to come out and just say this. But it's getting to the point that even Democrats, it's getting to the point that the progressives are even pushing against Biden, his administration, and all of the policy that happened over the last 4 years that has put us into this mess. And so here's a video from Jon Stewart. It's really a joke on how Joe Biden is planning on turning things around to beat Trump. So let's watch this real quick. I think you'll get a laugh out of this. You can tell that the sentiment, even among progressives, even among Democrats, are extremely unhappy with the approach being taken against Donald Trump. In fact, there have been many Democrats over the last few months that have come out openly and said this trial that's happening in New York is clearly political and is a bunch of shenanigans. It wouldn't be happening to any other person. They're still a Biden supporter. They're saying they're going to vote for Biden, and they're saying these trials are completely bogus. So it's really shining a light that even people who side with the Democratic Party, there's a large group that is forming that are saying, we're kind of sick and tired of this approach. Even this video from The Daily Show with Jon Stewart highlights the idea that, like, what happened to just winning by votes? What happened to letting people decide who the next president's going to be? Why are we hyper-focused on all these other angles? And I think, guys, the evidence is clear. All of this data that I've brought to your attention is stacking very heavily against Joe Biden. And with a poor economy, what else can you use to attack the runner-up for president? You've got to find these other things that have nothing to do with the economy, because no one can blame Trump. He's not the standing president. He's not the person sitting in the Oval Office right now. It's Joe Biden. And frankly, the world, the U.S. in particular, is sick and tired of it. And these polls are showing that there's no way to avoid the data. There are more Democrats that disapprove of Joe Biden than any other time in the last 70 years. So I think we're all tired. And frankly, I think even Republicans are tired of Trump being the candidate. I think we've got two candidates that really no one's excited about. And so at this point, we're looking at policy. We're looking at, like, who will do the least amount of damage, Joe Biden or Donald Trump? And I think a lot of people are starting to say, well, when Trump was in office, a lot less damage was happening than what we're currently seeing. And so we're seeing definitely a pull to that direction. Not to go too much more into politics, but it's very clear that there are some shenanigans going on in terms of the world of finance and politics. And this is going to be a wavy year. They even say it's very common that during an election year, the markets typically don't end higher than where they started. And so there is a higher risk, just from a probability factor that you guys should all know of, that during an election year, the markets typically end lower than they start. And so has that happened yet? No, it hasn't. We've had gains so far at the beginning of this year. A lot of that's inflationary gains. But the odds are stacked against us as far as a market, and this being an election year. All right, so what's up? What's up next? Well, we have to talk about this statement and war that President Putin has really taken on with the U.S. This just came in, and let me show you this article highlighting this. And again, nothing you're going to find on mainstream media. Like, it's fascinating to me how you have to go diving in to find this data. It's like JP Morgan Chase is the largest bank, one of the largest banks in the world, and just had Russia seize $440 million in a court order. And they're going to take that money to apply to the war. And so Putin came out with a statement, and he was threatening this a couple months ago, and no one took him serious. But he is standing behind what he said. He's literally declared war on the U.S. dollar, not on the U.S., but on the dollar. And when we pulled out the SWIFT system from Russia, we disabled their ability to transact to foreign nations and to do international trade. Well, they have since then come up with alternative ways to do that, and digital currency is actually one of the ways that they're doing that. But let me give you some of the highlight bullets that kind of pull all of this data together on, like, what's going on with Russia, how is this a direct attack on the dollar, and why is no one talking about this? Like, why isn't the news sharing about what's going on here, and how is this going to affect you, your livelihood, and you being a citizen of this great country? Let's talk about legislative action. So in spite of all this stuff going on with Russia, as a countermeasure, U.S. Congress passed just recently, and again, something you're not going to hear on the news, the Repo Ukrainian Act. Now, just listen to the title of it. It's called the Repo Ukrainian Act, which allows for the seizure of Russian assets in American banks to be directly sent to Ukraine. So basically, we take Russian assets that are in U.S. banks, and rather than using the normal political process and SWIFT system to move money to Ukraine, we can now just pull that money out of U.S. banks, these assets, and we have the right to take them dollar for dollar and just ship them to Ukraine for this war. Now, that is a direct correlation It's one thing to send money to Ukraine. It's another to say we're going to take Russian assets and then send them to Ukraine. You're sending a message to Russia by Congress passing something like this. The digital financial asset law Russia has enacted will allow the use of digital financial assets in international trade, which after the U.S. cut Russia off from the SWIFT system, it circumvents all the traditional financial systems like SWIFT. And a lot of people go, well, that's small news. You know, Matt, how do you expect us to understand what this all means? Let me break it down to you. The fact that Russia can now transact using this new digital financial asset law, it allows Russia to not use the SWIFT, which the SWIFT was directly tied to the dollar. Now, if you understand market cap and you understand liquidity and you understand network effect on asset classes, you know that the more something's being used, the more value it has, because dollars have to go through. It brings up the value of the dollar, and then those who hold dollars, their currency continues to grow in value. And this is the opposite of what's happening during inflation. What's happening is Russia now is going around the SWIFT, so they don't, when they buy oil, billions of dollars in oil or energy or any type of resource that they're bringing in, they don't have to use the dollar anymore. In fact, they'll just go around it, and rather than creating and adding value to the dollar system, they're going to add value into their own digital system, and it actually devalues the dollar. It is a direct weaponized attack on the dollar, which for U.S. citizens hurts each and every one of us. It drives inflation, it devalues our buying power with the dollar, and as a currency, a global currency, treasuries are struggling because no one wants them. Now, this challenges U.S. dominance also, because if we don't have dollar dominance, the U.S. also starts to lose global dominance. And a lot of you may not know or understand the high impact, the high power grab that the U.S. has in terms of dominance over the globe. It's what drives the U.S. dollar. It's what allows people in the U.S. to own homes where in other countries it's next near to impossible. Well, if anyone's been watching the markets the last couple of years, that's happening in our country now also. And so this move by Russia is seen as a direct challenge to the U.S. dominance over the global financial system. And frankly, this was all established pre-World War II to really, the Bretton Woods Agreement really was something put in place to strengthen the dollar after we came off of the gold standard. And so China is loving this. Russia is loving this. Anyone who is not using the dollar or doesn't want to be tied to the dollar anymore is loving this because it allows new power to move up. And I would say the new global power that we're really being threatened by is China, and Russia is doing all the legwork. Now, this creates a potential global shift in our dollar and currency and global dominance. These developments could lead to a significant shift away from the US dollar and will, no question, affect global stability until this new thing emerges, which everyone in cryptocurrency right now is saying, well, that's what it is. Cryptocurrency will step in and become the new global economic form of currency. Now, this obviously has even more impact, not just on citizens, but on banks. And as we talked about earlier, we had one of the first bank closures this year, and we're likely going to have more because all of this impacts interest rates. If people aren't buying our treasuries, then the cost that we have to pay for people to buy them, the interest rate return we have to pay goes up, and that means that we have to continue to raise rates, one, to combat inflation, but also to handle our debt. And so the last thing we want, and the feds will do this, they'll buy back, it's like a complete Ponzi, by the way, but the feds will actually buy back the notes that they've been selling off to keep the value of them high so that they don't drop off a cliff. But there's a threshold at some point to this. We can't keep buying back our own bonds with more printed money. That's what causes more inflation. And it makes it harder for people to get home loans. It makes interest rates continue to go up and stay higher for longer. And so, one, we want this to settle. Two, we want dollar dominance to go the other way, not this direction. We want more dollars to be out there. We want more people to be using the dollar, more people to be dependent on it, especially if you're a citizen of this country. For those of you who think, oh, well, everything should be equal and across the board, great, just expect to have less. Because we have rode on the backs of other countries for years, and frankly, for doing nothing other than just having dollar dominance. And so this is something that U.S. citizens need to wake up to. Like, great, if you have a holistic life approach that's global and you think everyone should have things that are equal, well, then just start giving away your shit. Because frankly speaking, the reason you have a house, the reason that you can get a loan, the reason that your cost of goods and fuel costs here have been typically lower than anywhere else in the world is because of dollar dominance. And sometimes that's a 1-to-4 ratio in buying power, 1-to-4. And this is why when you would travel to England or you travel to Europe or you travel to other parts of the world and their gas prices would be 4 times as much, it would be impossible for anyone new to get a home. It was because their currency wasn't high in demand. And so there wasn't the buying power that we have enjoyed for so long since the Second World War. We didn't have that freedom. And so one of two things are going to happen. Either we get this figured out, politics get straightened out, and our dollar dominance comes back because of good policy. I'm not going to bet on that. I think our political system, it's not rigged, it's just broken. And so we're just going to continue doing these bad patterns. The second option is we'll go to war. And right now, all things are pointing to war. We are already and Putin has declared financial war this week on the U.S., and those things will likely escalate, and we will likely end up in another war. And for those of you who believe in equality, that is the last thing that's going to happen. We will use our force to eventually get what we want, because people, frankly speaking, don't like to give up what they have. And as a country, we don't like losing what we have. And until we start to lose it and everyone starts to feel it, then this equality thing just drops and everyone goes, no, screw everyone else. Screw other countries. We want to stay on top. And so that's the likely scenario. All right. That's a lot to unpackage in terms of bad news. And I hate to be the one bringing this to you. I am just shocked this week and how much of this has not hit mainstream media and the news. The only way you would find this is off-record, off-type news like myself that's frankly not afraid of being canceled and not afraid of having repercussions. Like, I have no advertisers. I have no one that's paying me that's going to stop advertising with me because I have the truth, and the truth hurts their political view or some bottom line that they're trying to promote. Luckily, we don't have any of those biases here, so I can report the news exactly the way I see it and with the raw data that's coming in. So, sorry, not sorry. All right, so next up, we're going to go into one of my favorite sections, which is around AI, that thing that we're all petrified of that will likely take over the world. Let's jump into that segment, and I'm going to update you guys on what's going on with Meta.
I'm back.
All right, so let's talk about Meta. Meta has an AI called Llama 3, and I want to show you just their website on this. They've got a really great page that introduces Meta's Llama 3. And this release of AI, this release as an LLM, a large language model, is shaking and making waves. What Meta 3 is, so Llama came out with Llama 2, and it was comparable to ChatGPT 3. And so when OpenAI came out with ChatGPT 4, it was knocking the socks off of anything that anyone else had. And so Llama 3, when it was previous Llama 2 that came out, Llama 2 was a complete open source project, meaning they dumped billions of dollars into this LLM, and Mark Zuckerberg at Meta decided to make this a open source project, meaning that the code and the script would go out to everyone and it would be free. It wouldn't cost anything, while Meta, tied to Microsoft, is charging. And for those of you who have a ChatGPT account or a ChatGPT anything tied to that, you're likely paying for it, right? You're not on the free version, myself included, by the way, because it's the best and it's really, really good. Now, Llama 3 just came out. I've tested it. I've ran stuff on it. And frankly, it's almost as good, if not as good as 4. So now Microsoft has an equal competitor. 2, it's completely free. It doesn't cost anything. And it's open sourced. So I'm going to turn over to something Jerome Pessan said. And Jerome is he's like an AI godfather. He's the founder of Sizzle AI, worked with Meta for a while. And he had some comments on what Llama 3 is and how it's going to impact things in the market. And here's kind of what he said. He said that running Llama 3 on a cloud platform such as Fireworks.ai costs just a 20th of the cost of accessing ChatGPT 4 through an API. He adds that Llama 3 can be configured to respond to queries extremely quickly, and key considerations for developers at companies like his that rely on tapping into models from different providers. He says it's an equation between latency, cost, and accuracy. And so Jerome, as one of these godfathers, has basically made the claim that Llama 3 not only is comparable, if not as good as ChatGPT 4, but is also, in some instances, a 20th of the cost to run on an inference than through ChatGPT 4's API. So if you have a third-party software and you're using ChatGPT's LLM, it's essentially costing you 20 times the cost. Now, because it's open source, why would Zuckerberg do that? There's no money, obviously, in printing. Well, let me share with you what I think the impact of this is going to have on AI. 2, how it's going to positively impact things. And then 3, negative impact things. Well, to have this be an open source project, to have Llama 3 coming out as a just open code, open source project, as far as innovation goes, this is not going to be something that stifles innovation. In fact, it will likely spiral innovation around large language models much, much quicker. Why, from a positive standpoint, why would Meta do this? Well, Google and Microsoft both had their own closed versions of this. They're charging for it and, frankly, leading. And so Meta really had a choice. They knew that they couldn't enter the pay-for AI phase or arena like OpenAI that we all are paying a subscription for now. They knew that they couldn't enter that arena, but they did know that if they made it free, it would disable the people charging. And so from a stock market valuation standpoint, how do you disable Microsoft? Well, you make something free that's just as good, and now the valuation that was plugged in towards Microsoft or Google on this paid-for version now completely goes away and it equals the playing field. It also creates a positive impact for Meta because Zuckerberg has actually made comments that he believes that allowing this infrastructure to be open source, the innovation that will likely come from it, will cut a lot of the third-party vendors and third-party services that Meta is having to use to make it internal and make it internal much quicker. So he's kind of counting on the race to AGI, the race to a full autonomous agent, really helping cut costs at Meta, and that race is more valuable than trying to be the one who charges for these LLMs and these chat for services. All right, so how does this negatively impact things? Well, if you were an investor in an AI project, if you're an investor in any language model training system, you can pretty much count on your investment going to zero. Unless that company takes a radical shift and creates new white papers on the direction that they're going and the allocation of those resources, the value in investing in and building LLMs has disappeared. Open source has now become the new way. And the way that you make money on open source has nothing to do with people using it. It has to do with the network, who you're drawing in from a network effect to use it. So then you can throw advertisers to them. You can make network effect connections that have people buy other things and other products. It's no longer about charging for the service, which is really sad because it really stifles startups from having big wins in this arena. Also, something I love about this, and this goes to Elon Musk's concern about AI, OpenAI started as a nonprofit. OpenAI was never intended to charge the way that it is and paired up with Microsoft. That all happened and literally cut hundreds of $millions out of Elon Musk's pocket and bid towards this being a nonprofit and an open source project. And so really what Llama's doing and Mark Zuckerberg at Meta's doing is making something that I think also should be free, should be open to the public, shouldn't be stifled by some company that has the ultimate AI. If we can get rid of the auspice that one company has the ultimate AI, we really lose the fear of someone using that to dominate all competition, manipulate political views and opinions, and frankly take over the world, like is basically what we're talking about. So this is a great hedge, in my opinion, towards best practices. This is a great hedge for humanity, is these open source versions of LLMs. And frankly, what Llama just came out with, there's a lot of open source projects out there that are crap. This is incredible, and there's billions of dollars that have gone into it. So if you haven't yet, go check out Llama 3. Check out its performance. It's going to shock you. It is incredible. And it might give you reason to not pay for ChatGPT anymore. I'm actually looking at it right now to see if I really need me and my company paying for all these accounts on ChatGPT. All right. So let's take this moment now, and we're going to segue into my favorite part, which is the psychology piece around investing and trading. The segment I call Bulls, Bears, and Brain Farts. So let's go into that.
Bulls, bears, and brain farts.
I wanted to share with you an idea that came up during a coaching session I did this week. So as many of you know, I take on clients for professional executive level coaching, people in all industries that are really looking to upgrade their financial situation in their business. They're looking to exponentially dial up their revenue levels. They're exponentially looking to create balance among and while growing and sustaining growth within their company. They're really looking not to have to take trade-offs in other areas of their life. This is the type of coaching I do for individuals. And one of my clients called me this week in complete breakdown. And this is common, by the way. If you're not a performer and you don't understand this, people that are top performers are in breakdown all the time. And I just wanted to share with this individual that the feelings he was having were valid, that they weren't uncommon, and they actually are part of a formula towards success. And when I saw this, I just had to share it with you because I think it actually is directly correlated to your investing. It's directly correlated to your trading in terms of your success there also. We have an expectation that this should be easier. And when we realign ourselves with reality, then we can actually get in line with how to get the results we want. So here's basically the idea of what I shared with him. So this is the definition of a winner's life. 80% of the time, you're going to feel like you're failing. 15% of the time, you're going to feel like you're just treading water. And 4% of the time, you're going to feel like it's over. Like the ship is sinking, I'm going down with the ship, we're done. And then 1% of the time, you're going to feel like winning. You're going to feel like I just won. And so that's a lot. That's 99% of the time you're in a place of not that winning feeling. And so this is what a winner does. This is the winner formula. They take that 1% and they hunt for the next time there's another 1%. And they stack it. We call this compound interest, where they take that 1% win day after day, week after week, month after month, and they slowly compound those wins on top of each other until they eventually have everything that they want. Like that 1% win taught them how to market. That 1% win taught them the rules of investing. That 1% win taught them, if it's trading, to let their winners run. That 1% win taught them to cut their losers short. That 1% win taught them that they have to have a long-term view versus a short-term view. All of these little lessons are little 1%ers that happen only 1% out of the other 99% that we talked about. And this is how people build empires. This is how true wealth is created from nothing. And it's no different in your investing. It's no different in your trading, whether it's trading every day, once a week, once a month. It just doesn't matter. The principles are the same. So if you find yourself feeling like you're failing, feeling like you're barely treading water, or the ship is literally sinking, remember that there's that 1% that you're hunting for to compound on top of. That's the goal. And then to grab that gem, hold on to it, and go back through the trenches to hunt for that next 1%, because those who have what you don't have a list of things that they're willing to do that you're not. And perseverance is likely the tone or the theme around why they're getting what they want. It's not that you don't know the work it's going to take. It's not that you know the failures you'll have to have. It's not to know that there'll be some education. You know all that. It's just, what are you willing to give up? And the person that has what you have, the competitor that's going to get there sooner, their list is smaller than yours. They're willing to give up just about anything.
You ever wonder why fund managers can't beat the S&P 500? Because they're sheep. And sheep get slaughtered.
So I'm going into my next segment, which is what we call Sheep Get Slaughtered. And I want to just go into the general markets. We've got a lot going on here, and I want to back this up because the platform, the way I'm doing this, is more long-term, so people can see from a skill set how to do a lot of this and use these tools. Specifically, I like using the tools on GreenChart. It's a charting software that I use and helps sponsor this program. But outside of GreenChart, we have no other influences, and frankly, GreenChart has no political agendas either. So here's what's going on. This is the S&P 500, and you can see that we've had a pretty large retracement over the last segment, and there's a lot of noise going on here. I should probably delete a lot of this so you guys could see this better. But I want to show you a fib retracement on this. Sorry, I'm just cleaning this up a little bit. Sorry, not sorry. I just want to show you from the low to the high where we're sitting at, and this is going to make a lot of sense. So we're currently at the 23.6 level retracement from the bottom of November of last year. And so a lot of you are wondering, like, the $5,000 price for the S&P 500, why it was such a strong support and resistance. It's because from Fibonacci, it is literally the 23.6% level. Now, based on market news, based on everything from consumer debt to debt defaults to closures, this news leaking out that frankly legacy news cannot keep holding back, I think that we're going to see some negative sentiment over the next month. which will likely take us to the 38.2% level, or the last support level we drew in, which is close to 4,800. So from a prediction standpoint on the S&P 500, I wouldn't be surprised to see lower lows than we saw this month into the 48 levels. And we're clearly in a new trend that you guys can see here that is short. And the S&P 500 trends have been pretty long, meaning that we've got a long ways to go. These trends have held up for long periods of time, even though there's an old saying that the market rides the escalator up and the elevator down. We haven't seen that with this trend yet, although the down candles have been quite faster than the up ones that we've had more recently. Now, there's a lot of things to say here. From a fundamental standpoint, you can see where the market opened. So January 1st was somewhere around here. You can see that the price was around 4,600. In order for the statistical norm to kick in around a political year, like a presidential year, the odds of the market closing below where it opened at 2024 has a higher likelihood than not, just because it's a presidential year. There's going to be a lot of fighting. Trump's going to come out with a lot of negative news on the economy to make Biden look bad. And so it's very likely that we'll see a lot more sideways movement, if not down pressure. The only thing that would kick this market up, and I don't think we have I don't think the U.S., the citizens, and Biden followers have really the appetite for more spending. Meaning the only way you get this up is we throw more printed money at the U.S. population that would end up somehow in the markets eventually. And I don't see that happening. I also, because we don't have rates dropping, I don't see money coming out of money market accounts and moving into the S&P 500, where there's supposedly almost $1 trillion sitting sideline in these money market accounts, these high yield savings accounts of 5% or more. And so if we aren't going to have rate drops this year, which is what Jerome Powell is pointing to, he's pointing to higher, longer, which I've been saying for the last 2 years, because we're going to have higher, longer, it creates kind of this problem that the biggest influx in money that could have gone into the market under a good market economy with lower rates would have came from this sideline cash. And by the way, there's a ton of it out there, but everyone's kind of happy with 5%, and it's like kind of a 5% guaranteed. So why would you put it at risk in the market, especially as we're kind of peaking out and coming into a downfall? If I can make at least 5% there, and the return year over year is not that great on the S&P 500 right now, and they're seeing a lot of doom and gloom in the reports. So unless we see radical rate drops, which I do not see, there's strong arguments. Even JP Morgan Chase said that we could likely see rates up to 8%, which would lead to mortgage rates at about 10%. There's no way money's coming out of those markets. In fact, I would imagine more money is going to go into those type of markets where those returns, frankly, are guaranteed, which will actually pull money out of these, out of the S&P 500. Also, from a fundamental standpoint, news this week also reported low deposits, lower than average deposits into U.S. banks. Now, I think a lot of this has to do with that war that we were talking about, and that would be like foreign money pulling money out and definitely not putting money into U.S. banks, especially since we somehow created a law that if you live in Russia, we can just seize like money from Russian accounts and send it straight to Ukraine. People are not going to be depositing significant amounts from foreign places into U.S. banks with this risk. That, I mean, would you do that? Would you, right now, based on what Russia just did to JP Morgan Chase, would you send a bunch of money to Russia? No. It's like wartime. And during war, these kind of rules around best practices around banking kind of go out the door. They just literally attacked JP Morgan Chase, which was an attack on the US dollar. So fundamentally, I'm looking more bearish on the S&P 500, especially with rates high. That was not the case with the strong economy, decent GDP, and rates positioned to drop this year. Everything else is going actually the opposite right now. And from a fundamental standpoint, I am bearish. Having said that, from a technical standpoint, over the last 2 weeks, we're also bearish, and the trend is strong that way. 5,000 is the price to break. We broke it last week. It's likely we will break it again. And I just, from a long-term standpoint, I don't see how this gets any better, which makes an argument for other asset classes. Let's look at gold really quick. Gold has also been going sideways and down. You can see, though, the trend is different. We've obviously nailed all this from the past, but let's just identify this new trend. Huge believer of gold right now. In fact, gold could have a major blowout if the public wakes up. If the public catches on to how bad things really are, people will start to resolve to physical assets that they can count on taking somewhere and buying a loaf of bread. That will likely happen as default rates on credit cards get higher. The public is so slow to react. They don't plan for these type of things. You do, but they don't. And so it's likely that gold is going to hold its price. I would not expect high retracements on gold over the next couple weeks, especially as bad news piles in. Fuel prices will continue to go up, which makes the cost to get gold out of the mountain higher. Also, as currencies continue to dissolve and people rely and their confidence in dollars or other currencies diminish, it will often flow into assets like gold and silver and things like crypto and Bitcoin, which we have seen the bull run around Bitcoin as well. So that's my fundamental and technical analysis on this. If you want to see a fib draw out, this will make a lot of sense also. This was around the first of the year, this climb. And I just want you to see these levels. Same thing, guys. With gold, we're sitting right at the 23. In fact, it just came down below the 23% level, which is the first level. It has a likelihood to go to 38.2. I would say it's probably going to hold here. Where the S&P 500, I would say the opposite, just because of the fundamentals. I think the S&P 500 is positioned to continue rolling down, where I think gold will likely hit this level and then bounce, which will equate to sideways movement or even possible new highs on gold. All right, so there it is, my fundamental technical analysis on gold and the S&P 500. Hopefully that helps. I don't know how many of you guys know this, but I'll kind of end on this fact. Here's a gem for those of you who like to invest. Have your money invested with some company or money manager. Money managers are going to hate me, try to cancel me for saying this, but this is the truth. The majority of people who manage other people's money, so money managers, these large institutions that take your money, promise you great gains in the market, the majority, well over 50%, in fact, I think the number is over 80% of them underperform the S&P 500, underperform. The odds of you picking a money manager to do better than you just putting your money in the S&P 500 and cost averaging month over month, just putting money in every single month like you do with your 401k, or your retirement fund, the odds of you overperforming the S&P 500 is worse than Vegas. You are better off going to Vegas on those odds than you are just putting your money in the S&P 500 and hoping you got someone in that high, 10% that performs better than the S&P 500. So my takeaway tip is go hold your money manager accountable. See if they've been outperforming the S&P 500. And if they haven't, I would take a strong look at why are you paying them 1 to 2% a year? Because that 1 to 2%, most of the money they're putting in the S&P 500 anyways, and underperforming it, and charging you 1 to 2% to do it. Why would you do that? Take a look at the data for yourself. Obviously, make an educated decision for yourself. But the truth is, most money managers underperform the S&P 500. And that has been a trend for a long time. I remember going to an event almost 7 years ago where the data was exactly the same. So go out, do your research, save yourself at least 1% to 2% a year, which compounded equates into thousands. I mean, depending on the size of the account, it can be up to millions of dollars in money that you get to keep. And frankly, the odds are better. So there's your little tidbit fact at the end. Hope you guys enjoyed the podcast. Again, Matthew Pohl, Market Pulse Podcast. I want to end on one last note. My book just came out. You can get a copy of this today. Please, if you get a copy, put in a positive review on my Amazon. I'm about to put together a campaign to launch this, so you'll start hearing about this book here in the future. But right now, you have an opportunity to kind of get a sneak peek of what the world is going to be seeing after I put together this campaign. And I just got my quiz complete, so in the back of this book is a page that will take you to my site where you can actually do my archetype quiz and see where you are lacking in a certain area of your life and the actual components and steps you need to take to hit the goal, reach the success that you've always been dreaming of. So get your copy today. It's on Amazon. Our Audible will be coming out in about 3 months. So yeah, and from me to you, thank you. For those of you who have already bought this book, thank you so much. We have sold over 1,000 copies actually to date, and I've done nothing to market this at all other than just my brand recognition and people trusting that something in there might have or apply to them. So thank you. I love your feedback. I appreciate, obviously your contribution, and it really gives me the freedom to give you guys data, give you guys insights, and more importantly, make a difference in your life. And that's what I'm going to stand for. So you guys have a great rest of your week, and we'll see you on our next episode. And that wraps it up for today. So have a great rest of your day, guys. Bye.